So guys, last time I wore Henley was showing all my man boob. Learned from that mistake, so buttoned up for safety, you know what I'm saying? Sorry guys, my mom called me in the middle of recording. I'm like, you know when Mama Wayne calls, you gotta pick up. 5 minutes in, can't even get my intro. Life is going great right now. What's going on, beautiful people? Welcome back to Cha-Ching with Meng, where my whole goal is to help you master your money. Guys, this week's episode, there's only one key objective, and that is all the types of investments you can make with your investment vehicles that we covered in last week's episode. So, without further ado, let's jump right in. Again, guys, I want to reiterate a public service announcement, and that is I am not a pro, nor am I a fiduciary, but I do have your best interests at heart. What I'm about to share is just based off my experience and my opinions. Take from it what you will. Hopefully, I'm able to add some sort of value to your investment knowledge, right? Two, I also want to reiterate again the fact that there is risk here, guys. No matter what type of investment you make, there is a certain level of risk that you are taking on. So be very cautious and cognizant about where you park your money. Last but not least, I want to say that what we're going to cover is just the very plain vanilla investments spanning the spectrum. There are a bajillion and one things you can invest in, from crypto, real estate, to even other people's debt. But for investing, I firmly believe in the KISS principle. Keep it simple. I'm not going to say the last word. So, like I said, very plain vanilla, tried and true methods, and we'll go from there. Whenever you make an investment, there are a few factors you want to consider, right? So one of it is risk tolerance, and that's a very personal decision. How okay are you with taking on risk, right? For me personally, I'm very okay with risk because I'm relatively young in my professional career that, you know, I can be a bit more risky with my investments. In case things don't work out, I can have time to recoup my lost gains. Two is your goals. You know, what are you saving for, right? Is it for a house? Is it for that ring? Wink, wink. Again, I'm dropping hints. Is it for retirement? Last but not least, also, you know, what's your time horizon? How long do you have to invest? 5, 10, 20, 30 years, right? Based off of these factors, you will be able to say with confidence how much you need and when you need to buy, so that can dictate your investing strategy. One thing I need to address before we start is the notion of fees, guys. So there are actively managed investments and passively managed investments. For actively managed investments, they charge typically 1 to 2% of your entire portfolio on an annual basis. That is a lot of money. So for the average American, I never would recommend an actively managed investment. One, because these pros, again, are not that great, and two, they take a lot of money from you on a yearly basis. I much prefer the passively managed investments. So typically, passively managed investments have fees of less than 1%. Personally, for myself, I would not invest in something if it goes above a 0.2% in terms of fee and expense ratio. So we'll talk about that more as we go through the episode. The first step of investment you can make is the money under the mattress mentality, where you put all your money into a savings account and that's it. Never do this. You will never get rich or financially secure by just saving all your money. You want to think about putting your money to work, right? Every dollar that you make should have a job, and that is to make you more money. And putting in a savings account does not do that. Besides your emergency fund that you should hold in a savings account, as I mentioned prior, every other dollar that you have to your name should be invested. So the money under the mattress mentality, you know, not a good way to build wealth, guys. The next type of investment we'll talk about is called a CD, Certificate of Deposit. That's where you go to the bank and tell the bank, hey, I'm going to let you hold this amount for a certain amount of time, after which I'm going to collect on that amount with a small amount of interest on top. The amount of interest that they will pay you depends on how much you give to them and how long you let them hold your money. I am not a fan of CDs for a couple of reasons. One, say you go, hey, the term is 12 months, right? But you say, I want my money back within 9 months. They will charge you an early withdrawal fee. Not a fan of that. Two, the rate that you get is not that great, guys. So, based off those factors, I'm not a big fan of CDs, and I would not suggest that investment for a majority of Americans. Another type of safe investment is bonds, and that's basically an IOU where you act as the bank and you lend your money to institutions, right? So there are government bonds and corporate bonds. Government bonds can be broken down to 3 different layers. So you have your federal bonds, your state bonds, and then your local bonds. For federal bonds, they are super, super secure because the federal government will never default on itself. And if they do, we have bigger issues at hand. Corporate bonds can be broken down into, highly stable bonds or junk bonds. So that's based off credit ratings. So for very credit-worthy companies that are financially stable, think of your Microsofts or your Apples, those are highly rated bonds. So very secure, very low risk of default. Now, junk bonds are from companies who have bad credit ratings or aren't as financially stable, right? So in order to incentivize investors to invest in them, they will give you a much higher interest rate. The risk here is that when it's time to collect, you might not see your money because the company might go bankrupt or go default, so on and so forth. Personally, I'm not a fan of bonds because I have a much longer time horizon, but for people who are closer to retirement, bonds might be a good place to consider. Guys, I realize I've been on all the investment options I've been giving thus far between savings accounts, CDs, and bonds. We will talk now about one that I love and I personally own money in, and that is retirement date funds. So retirement date funds are great for the lazy investor who wants instant diversification and just wants to continuously buy one thing, invest in it, and kind of forget about it and move on with their day, right? They are essentially investments you make based off of your projected retirement date, whether it be 2030, 2040, 2050, so on and so forth. The cool thing about retirement date funds is that it will automatically go from high risk investments to low risk investments as your retirement date approaches closer and closer. So there's a lot of pros to retirement date funds. One, it is super cheap, so the expense ratio is really low. And two, like I said, it automatically goes from high risk investments to low risk investments, so you don't have to worry about asset allocations or rebalancing your portfolio or anything like that. So guys, I'm going to pull up on the screen a screen recording of an actual retirement date fund to kind of walk you through it. So here we go. We're going to try something new. So what you see here is the Vanguard Target Retirement 2060 Fund, ticker VTTSX. So if you're projected to retire around the 2050s, 2060s, this is a great retirement date fund for you to potentially invest in. This is actually one that I hold personally. So you have your product summary, your expense ratio of 0.15. That's actually really good. Like I said, my personal threshold is that 0.2 or lower. Your performances, so on and so forth. One thing I always look at is kind of the portfolio management piece. Currently, as of right now, what it's holding right now, it's at 88% stocks, 9% bonds, and then a little bit at 2% of some other thing. I quite frankly don't know what that is. But this asset allocation, this pie chart you see, will shift more and more towards safer investments like bonds as you get closer to 2060. Something I also like to look at are obviously the fees, right? One thing is you want to keep as much money to yourself as possible. So for the expense ratio here, for the target date fund for 2060 as an expense ratio of 0.15. Again, that's really good compared to other investment options that charge, 1, 2%, so on and so forth. What you'll see here is, it tells you that the average expense ratio is 0.46. So Vanguard's retirement date funds I'm a big fan of. Again, not sponsored, but, I would never tell you to invest in something that I don't. And again, like I said, this is something I personally invest in as well. The next investment we'll talk about are ETFs and index funds. I'm a huge fan of these, so let's jump right in. Index funds are exactly what they sound like. They are an investment you can make that tracks an index, whether it be the S&P 500, the Dow, or the NASDAQ. So if you buy something that tracks the S&P 500, right, whatever the S&P 500 does, your investment will do as well. ETFs are exchange traded funds. So think of ETFs like a basket, right? And what's in that basket is dependent on what the ETF is based on. So an ETF can track an index like an S&P 500, or it can track sectors of the economy, whether it be industrials, energy, finance, technology, so on and so forth. So a lot of people will confuse ETFs and index funds and use them interchangeably. And you can see why, right? There's a lot of similarities here, but there's one critical difference, and that is ETFs trade like a stock. So you can buy and sell ETFs as much as you want throughout the trading day. Index funds are a bit more limited as to when you can buy and sell them. There are a lot of pros to purchasing and investing in ETFs and index funds. One, they are super low in terms of expense ratios. Two, you have instant diversification. So one of the rules of investing is always to diversify, and diversify again, right? So let's say you buy an ETF that tracks the S&P 500. With each share of that ETF that you buy, you instantly have exposure to 500 different companies. Last but not least, ETFs and index funds are typically relatively inexpensive, so very low barriers of entry. Guys, what you see on the screen right now is an ETF called SPY, ticker name. So if you wanted to purchase this ETF, go into one of your investment vehicles, just type in SPY in the search bar, and you should be able to pull up this information. So this ETF tracks the S&P 500. So whatever the S&P 500 does, this ETF will do as well. I'll go into detail of all these data points later on. But for right now, just know that one share of this ETF costs $320.91. When you scroll down to the top holdings, these are the biggest companies in terms of percentage of the SPY ETF. So 6% of it is Microsoft, 5.78% is Apple, so on and so forth. And what you'll see here in the fund summary is that, exactly what it says. The investment seeks to provide investment results that before expenses correspond generally to the price and yield performance of the S&P 500. So what that means is it will try to mirror the S&P 500 before fees are taken out. So how much are the fees for this this ETF? I believe it is, give me 1 second, profile. What you see here, so 0.09% on the screen is the expenses. The next type of investment we'll talk about are mutual funds. So mutual funds are essentially you giving your money to a pro for them to manage, to actively manage. So again, actively manage means that they will charge anywhere between 1 to 2% annually as their fee. So this pro will buy and sell investments based off of what they think will outperform the market. I'm not a fan of mutual funds, as you might guess, because again, these pros do not make consistent returns that beat the S&P 500, and two, they have a very high barrier of entry. So minimum requirements typically range anywhere from $10,000 to $20,000 to even get in the door. So for those reasons, I would never recommend a mutual fund to the average American. Moving on to individual companies, guys. This is a moment of do as I say, not as I do. Full disclaimer, I do hold individual shares of companies, but I really wouldn't recommend it to people because of a few reasons. One, it is super risky, guys. So, personally for me, how well my day goes is directly dictated around how well my individual companies do. Two, you do not know as much as the pros, and that's not a jab at anyone, right? The pros have technology and knowledge that we as the general public do not have. So they're able to buy and sell and react a lot better than we can. And three, it's a lot of work. So I personally read up on everything that comes out around the companies I hold, but that's personally because I love doing this stuff. So for those three reasons, I really wouldn't recommend it. However, if it's something that is, of interest to you guys, I can do a separate video in our next series around what I look for when I invest in individual companies. The last type of investment we will talk about today are commodities. So commodities are anything like oil, corn, wheat, whatever the case is, coffee even. Quite frankly, I don't know too much about it because I don't follow the commodity market, but I do want to give that plug really quick. For your personal finance fitness challenge, guys, I want you to dive a little bit deeper and figure out what you might potentially want to invest in, right? So for some tips, I always recommend potentially a target date fund because it's super easy to invest in and it's pretty mindless. Two, I always recommend an ETF that tracks an index. Personally, I skew towards the S&P 500 because it's a lot more diverse. And three, find an ETF or a few ETFs that you like to cover in terms of sectors, right? Whether it be financials, technology, whatever the case may be. Personally, I like the tech space, as you can tell, hashtag millennial. So, find a few investments that you would like to cover and jump right in, dive in, buy a few shares and, follow your investments, read up on how they're doing, so on and so forth. For your too long didn't read, guys, I think this might be our longest video ever based off of just how many cuts I've had to do. So if you've been watching up until this point, thank you so much. Today we covered the range of investments most investors know, from low risk like CDs all the way to high risk like individual stocks. In our next episode, we will talk about legacy for your money. So stay tuned, more to come there. As always, guys, I hope you found this content useful. If you don't mind smashing the like button, subscribing, all that good stuff, because this does take a lot of time and energy to, record and prep. But, like I said in my beginning, if I can help just one person, I will keep doing it, right? Again, I'm not rich. I plan to be. Let's go on this journey together. Bye, guys.